This is a remastered replay of one of our most popular episodes. Enjoy. Some of the things we're talking about today, they're going to be true for sophisticated investors, but may not be true for unsophisticated investors who are looking for the wrong things. And so in some cases, we may declare something true and you may bump into an investor who is not looking for this thing or is giving you a mixed signal. They're not playing the same game. And so you need to be really listening out for and careful to observe when an investor is looking for the wrong kind of thing in your startup and frankly, respectfully run for the hills. You're listening to the Startup Podcast, a show focused on helping you build, run, and invest in Silicon Valley-style startups. Whether you're an investor, founder, or operator in a startup, you'll gain insights on the principles that power high-growth disruption, the way Facebook, Google, and Uber do it. The conversation starts now.
I'm Yaniv, a software engineer, operator, coach, advisor, investor, and people geek. I've worked at Google and a number of scale-ups and am now co-founder at Circular, a high-growth startup.
And I'm Chris Saad. I've been building products, marketplaces, startups, go-to-market strategies for over 20 years, including 10 years in venture-backed businesses in Silicon Valley. And now I'm helping a small handful of companies fast forward to the best high-growth outcomes as quickly as possible through one-on-one advisory work.
And our job on this show is to guide you through the unique mindset and approach that drives Silicon Valley-style disruption at scale.
In this episode, we're discussing fundraising, specifically the different stages of funding, what investors look for, and the mechanics of running a fundraising process. This is a really, really big subject. So what we're going to do is break it into multiple episodes. Maybe we'll do 2 or 3 episodes on this subject. By the end of this episode, we'll cover what is dilutive capital, what are the various stages of fundraising and the various sources of funding, what investors look for, and whether you should be selling the big picture versus the immediate tactical reality. We'll move into the other topics in the next episode. So Yaniv, let's jump straight into it. What are the stages of funding?
So this is one of those things that's evolved over the years, and I'm actually in the middle of some fundraising for my startup Circular, so it's very much front of mind for me at the moment. The traditional fundraising stages are Series A, Series B, Series C, and then sort of Series D and beyond. They're obviously named simply in order of when you raise them and the level of maturity of your company. But more recently, seed raises before Series A have become nearly standard, and increasingly common is also now what's known as a pre-seed raise. So what you can see actually is companies are raising earlier and the number of stages is growing. So we have pre-seed, seed, Series A, Series B, and then kind of everything after that is what you call a growth round. Each stage has a sort of rough rule of thumb about what the valuations are going to be, what the size of the round being raised is. But just as important, and we'll get into this shortly, is the things that investors are looking for at each stage are different. And so as you think about your fundraising, it's important to think about what stage are you at as a company. And so when you go out and raise money, what is it that you need to demonstrate to investors to win their confidence at that stage?
There's also increasingly, I find, little bridge rounds along the way, right? So you'll often hear of a seed extension or a bridge to A or an A extension, which sometimes make their way into the rounds. But broadly speaking, the set that you just described is absolutely right. And as you said, each of those labels implies a certain thing to investors. And I find entrepreneurs get a little wrapped around the axle in terms of what should I call it and how do I think about this and what does it precisely mean? And I think it's worth pointing out at the outset that these labels are really more about a little bit of expectation management. They don't strictly mean anything. They just imply a certain kind of company at a certain kind of stage, at a certain kind of raise amount, at a certain kind of valuation, with certain kinds of evidence or key milestones achieved. But there really isn't absolute rules at every stage, just kind of broad guidelines to help frame the conversation.
And I actually think it's getting messier and messier in terms of that sort of thing. It used to be most funds were stage specific. So you had a Series A fund, or you had a Series B fund, or you had a growth fund, and each of them had an opinion on the level of company that they wanted to invest in. So it was expectation management, but it was also about knowing which fund to speak to. Now, funds still have target sizes, but everything has gotten messier and grayer around the edges. And funds these days also tend to like to invest in multiple rounds. And so they actually have a much wider scope in terms of the types of companies and the stage of companies that they're looking for. So again, there's a bit of expectation setting, a little bit of find the right fund for your stage. But you're absolutely right, Chris. These days, it's quite often just about having the conversation and seeing where the value and vision match with the various funds. As a quick aside, we're talking here about equity raising, and I don't want to give like an equity raising 101, but suffice to say that an equity raise means you're selling a piece of your company to an investor in return for money into that company. And that's what an equity raise is. And when we talk about venture funded startups, which is what this podcast is about, that is really typically funded through a series of equity raises where successive funds buy pieces of your company in return for funding, and then they hope that the value of their stake grows. There is a new term, although definitely not a new type of funding by any means. It's the oldest type of funding, which is often referred to these days as non-dilutive capital. What non-dilutive capital, one way or another, is a form of debt. So with non-dilutive capital, what you're doing is instead of selling a piece of your company, you are just borrowing money, and at some point you will need to pay it back. Now, there are some really innovative structures these days happening around non-dilutive capital. So it can look quite different from a traditional bank loan. But just so you know, when you talk about non-dilutive capital, that's more like debt. And equity raises, they're dilutive in the sense that you end up owning less of your company after you raise than before you raise it. And so hence non-dilutive capital is contrasting itself against that.
In Silicon Valley, this non-dilutive capital was known as venture debt, actually. So there's venture capital and venture debt. So that's another term for it as well. This is actually pretty fundamental, and I think depending on who's listening and how familiar they are with all this might be really rudimentary, but I think it's really important to understand this is not about taking a loan from the bank. This is not about someone giving you money. This is about someone buying a piece of your company in return for giving you the capital to accelerate the growth of that company and accelerate the success of that company. And that's a really important mindset shift for a lot of people who are used to taking out debt. Going off script a little bit here, Yaniv, as we've been talking, we've been using the word fund, and I'm sure we're going to use the word VC or venture capital. I think it's worth defining the sources of this venture capital, or this capital for purchasing parts of your company. So just to do a really quick hop, skip, and a jump through some of these terms. There are angel investors who are typically individuals who have a high net worth. They have just a bunch of cash laying around, a bunch of assets laying around, and they're willing to put small check sizes, typically 10, 20, 50, sometimes $100,000 into a company because they like you, they know you, they want to give back, they want to start making high risk bets on the next generation of up and comers. Typically, they've come from the tech community, but maybe they've come from real estate or some other form of success and they want to diversify. There are then family offices who are very, very wealthy families who maybe want to formalize that process. So if angels are doing it a little bit on the side as a little bit of a hobby, family offices are really like they've possibly hired someone to manage their money and they're taking formal pitches on a regular basis and deploying capital in a very methodical way. There are syndicates where angels or family offices will put together multiple investors to raise a bunch of capital between them to then invest as one entity on the cap table through maybe what's called a special purpose vehicle. And then there are the good old well-known venture capitalist. Maybe the term is well-known, but not how they work. These are professional institutional funds who have been set up. They've raised capital from what are called LPs, limited partners. They have a big pool of money sitting around, and their job is to deploy that capital into a particular kind of company, typically a high growth, high risk Silicon Valley style startup.
And you know what? As you speak, I realize that we can and probably will at some point do a full episode on this whole kind of bestiary of different sources of funding, because understanding these organizations and individuals, how they think, how they work, how they're incentivized is actually a really great way of making sure that you sell yourself to them correctly and create a mutually beneficial deal. So maybe that's a great way to jump into what it is that investors do look for when they're considering an investment in a startup.
As you said, each of these different kinds of investors at these different stages of investment might be looking for something slightly different. And that's particularly true when you're talking to inexperienced angels who don't come from the tech world, or VCs that have been set up kind of to ride the startup bandwagon, but don't necessarily have the right traditional experience in terms of high growth venture-backed startups. And so some of the things we're talking about today, they're going to be true for sophisticated investors, but may not be true for unsophisticated investors who are looking for the wrong things. In some cases, we may declare something true and you may bump into an investor who is not looking for this thing or is giving you a mixed signal. Understand that that investor is either unsophisticated or is playing a different game than the one Yaniv and I have been describing over the last 3 or 4 episodes. They're using some of the same terms, but they're not playing the same game. Maybe it's also fair to share the slightly more pejorative or brutal terminology for this. There is what's called smart money and dumb money. I'm using the word sophisticated. In private conversations, people use the term smart money and dumb money. It's a little bit pejorative, but that's the shorthand. And so you need to be really listening out for and careful to observe when an investor is looking for the wrong kind of thing in your startup and, frankly, respectfully run for the hills.
I think we're planning to end this episode with how to pick your investors, and definitely not all money is created equal when it comes down to picking your investors. We'll definitely talk about some of the warning signs. So first of all, let's talk about what investors look for. And with your qualification, Chris, what do investors who we consider to be sophisticated venture investors look for when they're talking to your startup?
So let's just rattle off some of the key things investors are looking for, and then we can unpack each of those in turn. Investors invest in team, traction, or technology. Team is essentially, why are these people uniquely qualified to do the thing they're doing and maybe have an unfair insight? Traction is how many people are using this thing and is it growing and retaining users? And technology is there a incredibly difficult technical hurdle these people have overcome that makes them unique in the marketplace? And I must stress, technology is often misunderstood. People feel like, oh, I've built a great technology, and really what they've built is a pretty simple SaaS app. Technology really is like incredibly unique breakthrough hard science technology, like some kind of self-driving car or something. So it's very often most startups are really leaning on the first two, traction and the team.
We'll dive into these in a moment. I also think it's worth bringing it back to the different stages that we touched on before. And these, again, are rules of thumb. And it's not that each of these things neatly moves on to the next. But one way of thinking about this that I've seen presented and I think makes reasonably good sense is the first thing you are selling is your team. Go all the way back to episode 2. We talked about ideas are cheap. So yes, you want to have an idea and a concept, but when you talk about that initial capital raise, you're really talking about the team that is going to execute on an idea. And that's often what the seed stage is for. You may have a little bit of traction to show, but mostly you're talking about, okay, this is the team that we have, and we think we can convince you that we're going to achieve big things. Then often around Series A is product market fit. So that's sort of the first part of traction, right? Where you can show that people actually like your product. It solves a real problem for people. And again, that's going back to episode 3, when we talk about early stage startups, pre-product market fit. At the end of that stage, when you have your product market fit, that's often Series A. And then you're off to the races, you're starting to grow. And once you have that growth engine really tuned and you know that you can pour more money into growth and get more growth out, that's what Series B and then the rounds beyond that often correspond to.
On the team, you really want people that have demonstrated success in the world of startups or demonstrated success in the particular problem domain that this startup is running and demonstrated success in operating things well. If I'm looking at the pedigree of a company that I'm going to invest in, I really want to understand, and this may be fair or unfair, right? And you may be sitting there coming from some of these backgrounds and feeling a little bit jilted by this. But if I'm looking at this team and looking at this deck and I see academic media personality, I'm going to think twice, right? If I'm looking at someone who's been in a big corporation consistently or exclusively for many, many decades and hasn't done anything scrappy, I'm going to be a little bit concerned. If I'm going to look at someone who has maybe been working on the problem for many, many years, but hasn't been able to turn that into any kind of operational success or hypothesis testing, I'm going to be very, very concerned. So what I'm really looking for is someone who has a demonstrated history of being able to execute something operationally, to build something commercially, or to move quickly and to understand operational and commercial realities. Now, that doesn't mean you can't or shouldn't have academics or what have you on your team. It just means you need a mix of people who have some demonstrated success and some unfair advantage in the domain that they're proposing to work in, whether it is startups or whether it is the specific problem domain that the startup is addressing.
One framework that I think of is Marty Kagan, who's one of the leading thinkers in product management. If you haven't read his book, Inspired, you should probably stop listening to this podcast and go read that. He talks about 4 risks to success of a new startup idea: value risk, usability risk, feasibility risk, and business viability risk. One way that I like to think about it is, do you have a team that can effectively address those 4 risks on their way to building a really valuable business? And the types of imbalances that you typically see, especially outside Silicon Valley, what I see is you often have people who come from more of a business background who are quite strong on the business viability risk and maybe even reasonably good on some of the value risk. They have an idea, they're good at modeling spreadsheets, they're good at making deals, they're good at sales, and so they can be quite strong there. But often what they're missing is some of that usability risk and the technical feasibility risk, which is why you often see these more business founders not successfully engaging with product and with engineering to really build a successful business. I think in Silicon Valley, it can be a little bit more common where you have the reverse, a couple of engineers or a couple of product managers founding something without ever having that strong sense of, is this actually commercially viable? I think where we are, Chris, that's less common, but definitely you want that sort of spread of skills on the team and that startup experience ideally in order to feel good that that team can really execute.
It's important to note what we're discussing here is the team dimension of team traction and technology. So even though your team might be a number of academics who haven't got proven history and execution, the way to overcome that is either to bring in another co-founder with some of that history, some of that pedigree, or to actually just go out and get traction. So if you don't have, quote unquote, the right team, but you still have faith in yourselves to be able to execute, then you need to go and do that. You need to come to the table then not leading with team, but leading with traction.
That's a masterful segue there. So let's talk a bit about traction then. Traction, I think, is sometimes used as a synonym for growth. And I think there's probably, I'd say, an 80% overlap between what is meant by traction and what is meant by growth. But maybe we can break down some of the key things that we look at when we look at traction. And this is probably one of the ones where we can break it down into metrics a little bit. And quick aside into the difference between strong growth metrics and what are sometimes called vanity metrics, which look good to perhaps the less sophisticated investors, but don't really mean very much.
Yeah, so let's talk about what you should be measuring and then what the actual numbers should look like. In the last few episodes, we touched on the subject about revenue versus growth. One of the things that are oftentimes not the priority metric is revenue. And as we said at the beginning of this podcast, you will find investors whose priority is revenue. And those are not necessarily playing the same game we're talking about here in terms of a Silicon Valley style startup. So revenue is not irrelevant, but it is not the primary leading metric. Another poor metric is registered users. The number of registered users is kind of irrelevant. The metrics that do matter are active users, 30-day active users. So how many users are actually using the thing actively? And then depending on what your thing does, something like transaction volume or interaction volume. So how much are those active users using your thing? And then a subcomponent of that is retention.
So this is the bit where we disagree slightly on something. We do that once each episode. Again, I agree with you about 80% on this. I guess I feel that the statement revenue is irrelevant or not that important is actually usually not true. I think it's true that you have these kind of pure consumer plays, and these are often the ones that are the most visible in the market. So let's imagine you're building a social media application, the next Facebook or whatever. And I think you can have a huge amount of growth with zero revenue, and that's fine. The vast majority of startups actually have a transactional aspect to them where at some point their users pay them money. And that is relevant, right? It's very relevant in B2B, but even in a lot of B2C, right?
I didn't say revenue was irrelevant. I said revenue was not the leading indicator that a sophisticated investor should be paying attention to. And the reason I say that is because more often than not, the vast majority of the startups I bump into outside of Silicon Valley are twisting themselves into a pretzel to secure revenue.
Yes.
And are pursuing what we've described in a number of episodes already, technology-backed services businesses, thinking that the more large transactions they're executing with large logos, large enterprise customers, the more likely they are to get invested in. And that might be true from a certain kind of investor, but it is not true for the kind of smart money that we're talking about.
Yeah.
What they want to see is, are you earning repeatable revenue through product-led growth? And often The only way to get entrepreneurs and founders to focus on that is to almost twist their arm to deprioritize revenue and to focus on building simple, delightful, repeatable products that a business will ultimately pay for.
Okay. So I think we're back on track with mostly agreeing as as usual. So let's talk about the money thing though, because I think there's one level deeper that we go here, right? So I agree, top line revenue, from the way that you put it, can be a very dangerous drug. When you talk about the revenue aspect of a business, what you're really looking for is high margin revenue, which is really another way of saying what you're saying, Chris, right? Which is if it's very repeatable and scalable, it is so because your marginal cost of servicing that demand is relatively low. And the term that often gets used by the smarter money is unit economics. And that really is speaking to, for every customer you add, show us how much money you can get from that customer on a marginal basis. So don't worry about your costs of investing in the software product or the platform. How much does it cost you to get a new customer and how much money do you make from that customer? And that should be strongly margin positive, or to use another term, it should be profitable. Every customer you add should either be profitable, or if they're not, you should have a very clear road to profitability at scale. And so I guess when you have a metric with a dollar number on it, high margin growth, growth with good unit economics is probably the bit where it is actually quite important to have an eye on that.
So, if you're actually interested in this topic a little bit more, we went quite deep on this a few episodes ago about early stage execution. We also touched on another aspect of this, Yaniv, where you may not need to be profitable on your unit economics out of the gate. And actually, you're likely not going to be. That's called investing in growth. And as long as you have a line of sight in terms of other features, other price points, other economies of scale, then that's perfectly fine. But you need to have some kind of line of sight to driving your costs down and your revenue up.
The word that comes to my mind is a credible path to positive unit economics, right? And do expect an investor, if you have negative unit economics, to ask you some very hard and detailed questions about how you're going to flip that around and get to positive economics at some point, which is completely reasonable.
Absolutely. So let's keep going through this list of things that investors are looking for. So they're looking for the team. They're looking for traction. I actually had someone ask me from one of our previous episodes, you talked a lot about growth, but like, what is the growth metric? What numbers should I be targeting? And the default answer, the common answer there is 20% month over month growth. It depends on the business. It depends on the product. It depends on the problem. What exactly is growing 20% month over month? But it's usually something like active users, transaction volumes, interactions. And yes, if you have self-serve revenue, it's incredible if you could be growing that 20% month over month.
This is very much stage dependent. So 20% month over month growth sustained for a year is 900% annual growth. And even the greatest businesses can't sustain that for a particularly long time at scale. So I think what you're talking about, Chris, is at that early stage when you're raising a seed or a series A, 20% month over month is great, but do expect that percentage to come down over time. One of the frameworks that's often used post A, like let's say once you hit $1 million in annual revenues, is called sometimes a triple, triple, double, double, double model, which is once you get to that certain scale, you should be tripling for the next 2 years and then doubling for the next 3 years after that. And that takes you to about from 1 million to 100 million over 5 years, which is considered a good rate of growth. You know, exponential growth is one of those things where true exponential growth can never be sustained for very long because you quickly run out of customers when you have everyone on earth signed up to your product.
Then you add more products, man. Come on, it's easy. Before we move on from this subject, it's worth talking about unfair advantages and moats. So the unfair advantage is really about, have you been earlier in your career in a position, in a place to see something that other people didn't see, or have a relationship that other people don't have, or to have a distribution channel that you have some special access to? So do you have an insight, a relationship, a channel, or some other aspect of your business that very few other people have? And that's something that investors look for. And we don't have to go too deep in that one, I think. The other is a moat. Sure, you may have built a number of features, you may have sold a number of customer accounts, but what stops your competitors from coming in and doing some of what you're doing? Sometimes the answer is simply those competitors are stuck in the innovator's dilemma and they're just going to move too slowly to turn their attention to what we're doing. But really, that's the weakest possible answer. You need to think about flywheels and network effects and business models that start to erode the possibility that someone else can just break into your market tomorrow with a new feature set.
That's right. And again, we're in this venture capital fueled world, right? So if your moat can be overcome by just some other founder coming in, raising a lot of money and building the same thing as you with that money, then you don't have a real moat. So that things that are moats are things that are difficult to replicate or just catch up on purely with money. So that is your community, your user base, your network effects, your technology, your understanding of the market that is unique, your brand. All of these things can be moats depending on the business that you're in. But you need to think, how do I make it harder and harder for someone else to come in with a bunch of money, whether it's a big incumbent or a showy new startup, and just come in and eat your lunch? Venture capitalists want to see that once you've got your growth, you become more and more competitive as time passes rather than less and less competitive. And that's part of what gives them some comfort, that you will have that time and space to become profitable, which, remember, you're not profitable, you're actually loss making once you actually reach a certain level of scale.
There are obviously weak moats and strong moats, and they're all plotted along a spectrum. I would think of a lot of users, or even brand in many cases, as being relatively weak moats, especially in today's day and age where people are willing to pick things up more quickly and experiment to try, and as direct-to-consumer marketing and so on. The moats that I like the best are flywheels and network effects, where the more users using your thing, the more value that you create, and therefore the more users use your thing, and therefore the more value you create. Social networks are very obvious versions of flywheel effects and network effects, but the more subtle versions are, for example, Uber has a very subtle network effect that people didn't really understand, which is that the more cars and drivers you have on the road, the faster an ETA is and the lower the cost to move that asset from where it is to where the pickup is. And so your unit economics improve because you get faster ETAs and lower cost to move the asset to where the pickup is. Therefore, you get more riders because your ETAs and costs are lower, which then drives more density, which then drives lower ETAs, lower costs, and the flywheel continues that way. Flywheels are really, really incredible and powerful moats. And if you don't have one in your business, I would encourage you to go find one. The next question I often get is, well, look, I have this really, really big vision, but you're telling me to get practical and pragmatic and do something really tactical. Like if you've heard the last couple of episodes, you'll heard us say, have a really big vision for a big problem you want to solve, and then promptly forget it and go find something extremely tactical and practical to go do and go get traction in the marketplace. And so after having done that, a founder will often say to me, well, what do I lead with, Chris? Like, I don't want to give up on my vision. I don't want to bury the lead, but you've told me that we need to go get traction. So do I start with the metrics and the traction, or do I start with the vision? I think there are multiple ways to skin this cat, but I'll tell you the way I go about doing it, which is the first slide might have some statement on there about a big, meaty problem, right? So something really ambitious, like, let's continue to use Uber as an example. Real-time logistics has not been disrupted in 50 years. Let's say something like that. Something really big and bold and ambitious. But the very next slide is like, we have solved a very specific and tactical problem. The problem is affluent people in San Francisco can't get around. They're willing to pay at least 50% or even in some cases 100, 200% more than taxi charges in order to get a nice car, show up every time and take them to where they're going like a baller, get out in a frictionless experience. That's our hypothesis, or that's what we've demonstrated. And we think that this is a X million, X tens of million, X hundreds of million dollar business globally. And we think if we just continue to execute the way we're executing, we're going to crush it. And it's just going to go really great. But then the next slide is, where does this go? And so then you say, this is just our first beachhead. This is what we've cracked so far. But we think there are these adjacencies in other markets or in other use cases or other personas where this goes from being multi-hundred million to perhaps multi-billion. And so even if you don't buy that, you buy this business being serious and substantial. And once we win that, which we're showing you that we're on our way, we can then go and win this other thing as well.
Sean Puri, who's like a bit of a presence on Twitter and has his own podcast, summarized this as the ABZ framework, which is basically if you're at A and you're trying to get to Z, all you really need to understand yourself and to communicate, for example, to investors is that A, where you are now, B, what is your next small step on the way to Z, and then Z, which is where your end goal, and everything else in between. Well, you'll figure that out. You'll figure out C once you get to B and so on. So completely agree with what you say. You've got to have this incredible dual focus, right? Where you've got a massive vision, something that is usually changing the world flavored. VCs like that. This is also where you can create a big business and have an incredible narrative. But then you say, well, okay, that's boiling the ocean. So what's the thing we're doing right now? A, B, Z.
Yeah, boiling the ocean is the feeling you do not want the investor to walk away with. If you come in there and say, hey, we're doing this, but we could also do this and we could also do this and then we could do this and then we're going to go do this and it's good. We're going to do all the things. The investor's like, dude, chill the hell out. You're just way, way too unfocused. Whereas if you go in there and say, we found a small, discrete, pragmatic problem, we are crushing it. And I really like the way you describe that, Yaniv, which is we think the next step is this and we are well on our way to winning this. And we think Z is this. And there's a series of very logical adjacencies to work our way from here to there. I think that's a really great way of putting it.
And one subtlety on that actually that I think is relevant is not every startup is going to make it all the way to Z. So if you can put a couple of milestones in there that are like, if you reach for the stars and fail and you land on the moon, right? So where are there credible businesses in between A and Z that if you just get there, you've still built something of real value and of real worth? Okay, so that seems to be a good place for us to wrap up this first episode in the series of at least 2 episodes on raising funds. So today we talked about the different stages of capital raising, talked a little bit about debt and non-dilutive capital, and then had a bit of a deep dive into really what investors look for. So remember, that's team, traction, and technology. And talked a little bit about how you balance the big picture and the existing traction that you do have as a team. Next episode, we will get a little bit more into the tactics and the nitty-gritty of how to run a fundraising process, how to think about what you ask for from investors, and how to differentiate that smart money from the dumb money. And if you're in the extremely fortunate position of having more smart money than you need, how to pick the right set of investors that will really support you in your next stage of growth. Thanks very much for tuning in. As always, we'd love you as subscribers on your favorite podcast app. Please tell your friends and colleagues about us. And we love ratings and reviews on Apple Podcasts, Spotify, or anywhere else. So thanks very much. I'm Yaniv Bernstein.
And I'm Chris Saad.
And we'll catch you in the next episode.